I know one person in studio is watching closely as to who's buying what. That's Ridham Desai, Managing Director of Morgan Stanley. Ridham, welcome to Closing Bell. Thanks very much for joining us. We've been waiting. We launched this show just to have you here in studio with us. So we're delighted that you could be here.
I know that, Monica, but I'm delighted to be here as well.
Honored, honored. That's the word that you should use. So 1,000 points in what? Barely 2 months, 3 months?
Yeah, 73 days.
100 points, yeah. 100 points.
Do a lot of counting.
100 points in 24 hours. What do you make of the speed? Seriously, what do you make of the speed with which we are moving up at this point?
See, I think there's a global rally in equities. It is not just India. And we are underestimating how much of this is global, actually. So obviously, there's a very big India story that a lot of people have a lot of faith in. I've met a lot of investors across the world, from Japan all the way to the other side of America in the month of July. And nobody actually was bearish on India. So people have amazing faith in the potency and the execution capabilities of this new government. So far, so good. I think it seems like they're sending the right signals out there. So investors' faith is rising. And you have this push from the world. It seems like a Goldilocks scenario. It will change, mind you. It was not going to go up 100 points a day forever. But I think I feel fairly comfortable with a 3 to 4 year view. As we were discussing in the break, you actually want to just shut this off for the next 3 years and let your money ride this market.
One disappointment that we hear when we speak to some investors is that this government's failure to articulate major reforms. Is that something that worries you, or do you think it's par for the course? What they've done is par for the course?
So, Senthil, this has come from a lot of people. Okay, it comes largely from journalists, not in India, but outside India. So my rhetoric is, so what are these reforms you're talking about? I want to know the list. Because back home it feels a little different. Okay, it feels like we're changing things which could not have been changed and which we did not believe could have been changed. Just easing up procedures, disintermediating the bureaucracy, disintermediating ministries. And these are changes which are, I think, far-reaching. In my view, they are big reforms.
So you're saying that there were reforms, I mean, stated policy reforms were already there in the books. When he moved on, administrative reforms made oil the system in a nice way.
Yeah, I think India has got the tailwind of demographics like no other country in the world. And don't underestimate the power of having good demographics. I can give you an example of where it doesn't work, like the Middle East. Okay, but it can work in India because we also have democratic institutions. What we need is more robust institutional framework, and we need better execution. So I think the work for the government over the next 5 years is to ensure that it leaves a trail of institutional framework, which, by the way, is what the Prime Minister achieved as Chief Minister of Gujarat over a 10-year time frame. So now Gujarat is running on its own. It doesn't require political intervention at every step. And hopefully, if he can leave that behind for India, I think we'll have a very glorious 2-3 decades. But, you know, these are hopefully not last famous words.
You know, I think, so, and I don't know how to read what the Modi government has done. I don't feel as optimistic as you, or as pessimistic, or as cynical as Senthil's question sounds to be. Though Senthil is not, I know that. What I'm amazed by is that a few years ago, or even a few months ago, if we had ever had to discuss India with virtually zero fuel subsidy on diesel, it would have seemed like a mirage. And we're standing there today, right? Yeah. We're at 8 paise. And this is the biggest structural reform that could have taken place for our economy. And it's happened in a gradual fashion, in an almost disbelieving fashion, but it's happened. And it'll change the way you perceive government finances, perceive the macroeconomy. I mean, when people look at it from the outside in, I'm sure in July when you were meeting investors, these are the things they're looking at, whether it is the UPA government and Mr. Chidambaram who put it into play, or, you know, Mr. Modi's government who might take it forward.
No, indeed, Menika, actually, one more point I'll make is I don't know how much this was televised on your channel, but if you see the last 2 months, the government has crashed expenditure. You know, the trailing 12-month deficit in March was running at 5%. In July, by the end of July, it's running at 4.2.
What's the quality of that?
It doesn't matter.
Okay. And what
do you mean? Quality means basically there is no now postponement of expenditure. In March, expenditure rolled over into April and May. So there was a big jump up. All that is now been absorbed. In July, we're running a trailing 12-month number of 4.2. the 4.1 target that was set in the June budget, which looked very unrealistic, which drew criticism from all quarters, now looks achievable. And mind you, the government has not yet divested a single crore of shares. It has not collected telecom revenues. These are without those revenues. So they have managed expenditure extremely well. So when you talk about diesel subsidy, obviously it's contributing to this. But this government means business. Now, it's not only about the government. We're also in a cyclical turn. Okay, so that is also something that's playing in the market. So you have a structural potential via the government's mandate. You have a global rally, which I don't think we should underestimate, and we have a cyclical turn. So it is Goldilocks, as I said. A lot of the confluence of a lot of favorable factors. Some of this will change in the next few months.
What is most susceptible to change? So let's assume for a minute that the structural changes in the economy will progress at varying speeds, but will progress given the nature of this government and the faith in it. Will the global factors remain as conducive? So, I mean, this is the question we put to everyone, and nobody has an answer, so they sort of find a way to evade it, or they say, who knows, we'll see in March, April next year, or in June, July next year.
No, who knows is the right answer, but let me just try and speculate what can happen. So I think it's a unique situation where we're getting into in 2015. India opened its doors to foreign investors in 93. Since 93 to 2014, we've been in sync with the US rate cycle. So when the US was raising rates, we were raising rates. When they were cutting rates, we were cutting rates. Example 2003, 2008. For the first time in India's history, since it opened its doors to foreign investors in 22 years, we may be doing the opposite, which is America may be raising rates, and we will be hitting the peak of our rate cycle. This pro-cyclical tightening, I think, brings uncertainty to our doorstep. And I really don't know how this will play out in the marketplace, but it is going to be an event that we have not got any experience of. So it will bring volatility to our market.
Where on the Richter scale would you put it? Would you put it between 1 to 5? Would you put it between 5 to 8?
I was going to say 6.
Okay. 6? So 6 is between 5 to 8.
So,
right? so that gives us a sense of the kind of magnitude of the events that you're anticipating.
It will be fairly disruptive. It has been when the Fed has changed. See, the Fed is preparing the markets by sending confusing signals, right? So it's kind of preparing the market not to have a one-sided view, because the Fed also does not want extreme volatility. But frankly, even the Fed doesn't know. Right? The Fed doesn't know how the labor data and how US growth is going to progress in the next 12 months. I mean, they're not magicians that they know in advance. They will also react as the economy in the US behaves. And therefore, the market will never be fully prepared for it. So there will be turmoil that will come to the emerging world, as it always does, and part of that will hit India. Hopefully by that time, India has made its macro adjustments. See, last summer, India was actually well on its way. But the Fed tightening or the taper hit us at exactly our weakest moment.
I think had just embarked on the process of sort of putting things in place, right?
And that derailed us, because I think that caused the political class to lose confidence in the measures that were being taken by the then finance minister. And we lost 7-8 months as a consequence, and the cyclical recovery is happening only now. Whereas it would have actually started in September last year, had that not happened.
Actually, can we be fair and say this is not necessarily the Modi wave playing out? It may be in the stock markets in terms of the gains that we've seen, but what we've seen happen in the economy is probably a Chidambaram and Rajan effect, given the measures that they took last year. If one, not that this matters at all, because it's very backward-looking and not forward-looking.
Let me not disagree with you, but add a point to make it a full point, which is that let us not underestimate the repair on balance sheets that happen only because Modi is.
I'll give you that full.
I mean,
I agree with that.
The amount of debt capital that could be raised, the amount of equity that could be raised, just the amount of capitalization that can happen, and as a consequence, businesses can actually turn around, is only happening because the sentiment is better.
Now, sometime back you set a Sensex target of 26,300 for June 2015. Would you now, since now we're sitting above that, 27?
No, that's actually revised. In fact, I was mentioning it earlier. It's 28,800.
28,800. So you would stick with that 28,800 target, or does what you spoke about, what the measures that the Fed could take, would that change it? Because
the way we approach this is that we have a bull, bear, and base case. So this is the base case. Right. The bull case is 33,900. And it's premised on the government taking more forceful action
by June 2015.
So I think if the government, so I'm attaching a 40% probability to the bull case, and that's a all near even probability. But it is premised on the government taking action and the Fed not disrupting things. So if the Fed remains benign and the government takes action, I think we will see a much bigger upside to the index.
Okay,
So those are two caveats.
That's the best case scenario.
No, but you asked
It's a bull case.
It's a bull
right?
case. It's a bull
Yeah.
case. But you asked,
America, for your viewers, for your viewers, do not focus on 12-month price targets. We're in the midst of a multi-year bull run, okay, and there's no point in trying to trade this thing. Okay, institutional investors struggle, right? They are experts. They still struggle. I think retail investors not even attempt that. Just play this
and stay
put your
invested.
money. Yeah, the best way to do it is to invest savings on a monthly basis. Households in India are dramatically under.
You're putting three of us out of a job, Ridham. This is what you're doing. You're putting three of us
advice.
out. Yeah, the
Okay.
next
Not
time you're
careful.
back is in like 2017.
I'll tell you the good news. Don't worry, you're not going out of job because people don't take good advice.
when you say that the government, if the government does the right things, what are the right things that they should be doing?
So I think in the list of the 4 or 5 things, one is continue to focus on fiscal consolidation with the emphasis on quality, which is cut back on consumption expenditure. The second is wind down Narega, or at least make it more productive. So these are 2 very important things. Third is kickstart an infrastructure cycle. It has not yet started, by the way.
No.
And for that, I think it's imperative that these divestments happen because that's the source of money. The fourth is tax reform, particularly GST. And I think the government is very optimistic that it will get the ball moving next April. And if that happens, I think it will be a pleasant surprise for everybody, including in the market. I don't think anybody's factoring GST in April. So that will be a big surprise, but I think that's the fourth thing. And the fifth thing is, of course, continue with these admin reforms to ensure that processes get eased out and approval processes get better and people can do business easier. So I think these are the 5 things. It's not expecting a lot, actually. We're not putting insurance and defense on this. In fact,
Insurance and defense are true. I think defense is not insurance.
I'm not too fussed about insurance FDI. I think those are not as crucial to the economy.
They never were. Actually, to be honest, it's a media creation. They never were the pillars of reform, so to speak.
They're signaling, but they're signaling desire to change things, which is fine. They have limited impact.
But if you can do other more basic stuff.
Yeah.
Or if we're doing defense, if we're doing railways, but not yet doing infrastructure because there are some sensitivities involved, your signaling mechanisms are already working reasonably well.
In fact, I would say railways is far more crucial than insurance.
Yeah,
and
agreed.
I will say around this is the real rate framework of the central bank. So you made a point earlier that Rajan should get due credit. I would completely agree with you. I think the emphasis that the central bank has put on real rates and the de-anchoring that they're doing on inflation is so crucial to this cyclical recovery that's happening. And they will probably continue doing that as they have, and that will be great for the economy. Okay. So if we keep real rates positive, more money will flow into equities, and as money comes into equities, the economy gets better because it's all reflexive.
Ridham, your model portfolio for the next 3 years, this is stocks that you should be invested in today and then chuck the key away, as you pointed out, and not look at for the next 3 years. What would the top 5 stocks be in that model portfolio?
I'm so grateful you're asking me a question with a 3-year view. So I think you should buy consumption. Okay, how much ever I don't like it with a 6-month view or a 12-month view, I think it is inevitable that consumption will do well.
Consumption is expensive also.
Well, no, it's not necessarily expensive because it depends on, there are lots of areas in consumption, but I'll break it down.
Some traditional names are expensive. So talk to us about the valuation point of view as well.
No, expensive is a very opinionated word. Okay. So
we're now in the metaphysical world of investments.
What does expensive mean, right? Don't judge stocks on the basis of PE ratios. They should be judged on their ability to generate cash, how predictable that cash flow is, and how much that is going to grow. A PE ratio will distort the nature of valuation. So, we recently wrote a piece of research which was titled Cheap Value versus Deep Value. So cheap valuations versus deep value. So cheap valuations are stocks which trade at 6-7 times earnings, but they are not necessarily deep value. Value is stuff which is going to generate cash flow when discounted at your expected rate of return, produces a number that is actually above the current share price. And that could apply to a stock that's at 40 times earnings and may not apply to a stock that's at 7 times earnings. So I don't think necessarily consumption is that expensive. I think there is a lot of value there. Amongst the consumption-oriented stocks, the stuff that I like the most is packaged food, because my daughter doesn't step into the kitchen, and I think the next generation is not going to cook in this country. So I think packaged food will do very well. So it's very simple approach. There's no complicated approach.
Are there any pure packaged food companies? Or there are companies?
No, what, packaged food or ready to eat? I mean, or fast food?
I think getting into it.
So look. I'm looking at the top 20 ranked stocks under your coverage, or rather Morgan Stanley coverage, and which are all rated overweight. And Nimesh, thank you for the data. Jubilant Foodworks features there. So I'm assuming this is an instance, and I'm not asking you about where that stock price is going to go, but it's an instance that plays into the philosophy that you've just explained.
Yeah, so you want to buy food. So that's one theme. I'm not so bullish about buying retail, for example. Okay. Because I think there's going to be change in the way Indians will behave.
Fair enough.
And I think we'll skip the whole retail thing, actually.
Why? Because of the net?
Yeah, I think India will just skip. So this brick and mortar retail is something
So are you positioning yourself for e-commerce?
Well,
Sorry, I keep asking this question because the last time we spoke to Ramesh, he's pointed out that the way he was doing it was to invest in logistics firms, packaging firms, all firms that
proxies for e-commerce.
Support services for e-commerce, right?
Yeah, they all come with risk, okay? Because, somebody is now talking drones. So then what do you do with logistics, right? What do you do with the courier service firms, right? If somebody is going to deliver stuff on drones, then they all come with risk. But yeah, as a concept, as a theme, it's something that you should find stocks. Unfortunately, we don't cover stocks, so I don't have any of them in my focus list. But that's one theme, consumption. In fact, in that theme, I would add autos. So food is one. The second is autos. So I think India is very heavily underpenetrated. As the road network improves, as urbanization happens, there will be a greater demand for autos. So cars, two-wheelers, I like the whole bit.
Auto ancillaries?
Okay, I just want to point out some stocks that we already have on the list.
Yeah.
Hero Moto, Jubilant Foodworks, Nestle India, and interestingly, even though you don't sound very bullish about it, Future Retail Consumer. Yeah. These are four amongst the top 20 ranked stocks. So I'm just picking randomly of Morgan Stanley favorite stocks. Yeah.
We rate stocks with a 12-month view. Your question was 3 years.
For 3 years.
Yeah.
Okay,
so there's a slight difference between buying stocks for a 3 to 4 year view and a 12-month view.
Most of these would survive your 3-year analysis as well.
Yes. Not all of them, but most of them.
Yeah.
So that's one area. Second is you want to buy financial services. India is, again, heavily underpenetrated. And if we had any doubt about it, we got the message from the Prime Minister as well. And I think there was an interesting clip this morning I saw on your channel with Mr. K.C. Chakraborty.
Yeah, that's right.
I think he makes a lot of sense when he talks about not being able to compute the cost of opening a bank account. I think we should not be even bothered about it.
Yeah.
Because we don't even know what the revenue from a bank account is.
He said he put the figure at some 20,000 crores or something like that. And he said, what are you talking about?
The fact is that financial services will penetrate rapidly. Rural finances, micro business finances, small business.
So we'd agree with you, but how do you play this? Do you play this through private sector banks, NBFCs, public sector banks? Are you looking at other forms of finance delivery that will sort of play out over time to come?
So I lay a lot of emphasis on the people who run the businesses. So whenever you are buying a business, I think you should buy the people, not necessarily the business. Because if the people are good, the business will turn out to be good. And I cite examples of several companies that started off as something and ended up being something else. Because the people were smart enough to see that what they were doing was not really worth it, and they changed the business.
Yeah, so but isn't that such a difficult selection parameter for us to understand which stocks are pointing to?
Therefore, I think private makes more sense over public in the banking sector. I think that distinction is very clear-cut in the banking sector. So I think you want to buy a few good people out there, and there are a lot of good bankers in this country. There's no dearth of good bankers. So I think private sector banks, non-banking finance companies as well, should do okay. So the banking sector is the other. So financial services is the second place where you want to put money. I'm a bit more reticent about industrials. Okay, I think the stocks traded up a lot post-elections. They became a bit too rich on valuations. They didn't.
But you just destroyed our entire basis for determining. Look, I get they're not cash flow companies at this point in time at all. So I get your valuation point. But why are you looking at valuation in this case if you want to
valuations in the sense they were not giving me enough value. So they were pricing it too much about the capex. And I think you can wait a little longer. Capex will take a bit more time to come back.
Won't it become more expensive a little longer from now? Because everybody will be subscribing to exactly that philosophy. That
yeah, they have become
the fundamentals will catch
they've
up
become
only 6
cheaper in the
months.
last 2 months.
Yeah.
So I think you will get a better opportunity to buy them. So I think I have the luxury to wait, and I'm hedged because I own financial services.
Okay, which is
That's a plus.
So you don't go too overweight any particular theme. If you buy industrials and financial services, then you've got too much of capex in your portfolio. You need a bit of consumption as well. So that I would avoid industrials. I love technology. I think Indian companies are set for a multi-year run on US demand.
Okay.
And it is underestimated by the marketplace right now. Stocks are not rich. Most of these companies or most of these stocks are trading at very reasonable valuations. And I think their earnings are being underestimated. So I would be overweight technology. Which is
are there enough large caps to bet on? Would you need to go into mid caps?
I think you can go across the cap curve. There are micro caps to large caps. We don't cover the micro caps, but everything in that space looks interesting. There are companies who are doing niche stuff. There are companies that are doing product.
Would
there
you
are
say
companies
the
doing
same
cloud.
thing, Ridham, if US GDP data for the third quarter and the fourth quarter came in at between 1 and 2%? The reason why I'm asking is every time we talk about IT stocks, and this is, the conversation that goes on, either it's a rupee play or it's a US growth play. It's very rarely a play that distinguishes between what one company does in technology versus what another company does in technology. So I'm just curious,
Really?
do you play the sector? Do you
Then
play
explain the difference in the performance of Infosys and TCS over the
No,
last
but it's
5
also
years.
management and a growth thing.
There you are.
Yeah, no, I'm saying.
Of course it matters what the
but look at
company
how
does.
Infosys is on everybody's buy list right now.
No, see, if
Even though the companies, the incoming new management or whatever.
So let me get technical about this for a moment. So if you are right, then the correlation across stocks in the tech sector will be very high, right?
No.
Because you are saying that it's a top-down story, it's a macro.
I'm saying this is how people
it's a
usually
commoditized story.
recommend playing the sector.
Yeah, no,
So typically if you see currency movements, they'll say, oh, but this is favorable for IT. IT is a good place to get into. Or if you see US GDP. The question I was putting to you is that the right way to look at it? How do you distinguish between companies in this whole process?
No, you can make the same point about food, right? Which is that there is going to be good demand for packaged food or retail food in the country, therefore buy all food stocks. It doesn't work that way. There's a good macro setting, and then you have to apply micro parameters to pick up the stocks.
Okay, so back to my first question. If US GDP growth came in at sub 1% over the next 2 quarters, would you still make this case is my question?
So we have just published a report this morning, which is a joint report by our strategists and economists in the US, talking about this being the longest business cycle, possibly the longest business cycle in the US in a long, long time.
Okay.
So we
don't think that scenario that America points out.
No, I'm asking. I'm
so
not
it could happen
stating a
one quarter
scenario.
here or there. You could always get, and the GDP data in America is tending to be very volatile because of seasonal effects. But the underlying growth momentum is picking up. And therefore we think that tech companies should do well. I'll tell you one more reason why they'll do well. I think US is coming back as a manufacturing base. And therefore they will demand more services. They don't have the size of workforce to take care of the services demand that will emerge out of a renewed manufacturing thrust. And therefore I think, again, Indian companies, and this is not just software services, but even the guys who are BPOs, will actually do quite well.
Okay.
So you could actually see the list that Varinder just talked about, quite a few BPOs in there.
Okay, the smaller.
So I think institutional investors...
None that you have invested in, I bet. Not one. I'm willing to bet that. Not one. I like the way you allude to that.
How much money
list.
are you willing to bet?
No, not much.
Because then after this program, I will show you my portfolio, and then we'll know, right? So you let make it worth it for me to show you.
Have you invested in the stocks that Varinder spoke of? Ridham, no matter what I bet, you're not going to talk to me about your personal portfolio. I know that. So.
I promise you, if you put enough money on the table, I'll show you my portfolio.
$100 bucks?
Oh God!
Not enough.
Simple $100 for me to
Look,
show
it's
my
proportionate
portfolio.
to my pay in this organization.
Oh yes, of course it is.
Okay.
I was going to say 100,000 anyway.
Wow.
How am I selective? I think it's a good environment with all these patent expiries and a lot of drugs in America that will be launched by Indian companies, but you have to be selective. I don't think it's across the board. So selectively, you should obviously own some pharma in your portfolio. But if you're an institutional investor and if you're overweight consumer discretionary, if you're overweight financial services, then you probably get underweight pharma and consumer staples.
Okay,
because
so
you need to fund that.
Yeah.
But in a personal portfolio, in a retail investor's portfolio, it doesn't matter because you're not benchmarking against the index. So you should and therefore own some pharma stocks.
I think the one sector we haven't discussed is metals. We're in a bit of flux right now with what's going on the coal order, but nonetheless.
No, there's a fair bit of value there. So,
in metals.
Yeah. So I think notwithstanding, of course, there will be some idiosyncratic risks that will arise out of the coal order. But there will be a few companies that are not going to get affected. And those companies, I think, the shares of those companies are trading at reasonable valuations. So I would actually be overweight that sector.
Okay. So you've given us
also energy, because I think energy is going to surprise us on the upside in terms of profits.
Across the board, energy?
Well, largely public sector companies. In fact, that's one area where I'd love to own public sector companies.
The only area, probably.
Normally, I'm not a big fan of owning public sector stocks, but that view has changed since
NTPC, PTCs, whether it's across energy.
Well, not the utilities,
not the utilities, okay.
but the energy stocks, which is both upstream and downstream. And since Narendra Modi has taken over PM, I think there's a bit more optimism I have about the PSU names. Okay. So I think there is an urge to reform them and to generate greater returns. So I think people will make money. So you want to stick a couple of PSU names into your portfolio, and the best sector I think is energy, and the next one is materials.
So I'm looking at the list of stocks again, and I'm sorry, I keep going back to stock-specific conversation, which you don't like, but just to try and give some illustrations to people of what Morgan Stanley is overweight on, and that includes, for instance, Bharti, Crompton Greaves, Havells India. We've spoken about HDFC, Hero MotoCorp, HPCL. Oberoi Realty. I'm just trying to mention stocks where we may not have discussed those particular sectors.
Real estate is good. I think the thing that we missed here was real estate.
Real estate.
Again, it's part of the financial sector, but I think given how India's housing demand is likely to unfold over the next few years, companies that deliver houses should do well. So I think the mid-cap real estate stocks are decent companies. They don't have much leverage on them. The larger companies have leverage, so maybe not, but the smaller companies, I think, look quite decent.
Well, what do you do for more near-term games? I know you're talking 3 years, Ridham, but, I'm sorry, not all our viewers uniformly look at only 3-year term or 3-year horizon.
What is near-term when you say near-term?
So, I mean 3 months, 6 months, is there any...
You really want me to tell you that?
Well,
so you toss a coin. If it's heads, you buy. If it's
tails. This is that old experiment of monkeys and darts and whose portfolio did better than the other.
Okay, so I just got the SMS from Menika. She says 100,000 rupees on the table.
She has?
Yeah.
I don't have a phone to SMS. That's just the worst lie.
You know what I'm going to do now? I take the money first.
No, worse lie. I know Anuj has a question. So, if Anuj is around, he should put that in. But before that, I just want to ask you one thing about, I know you've made the long-term bull case, but I also want you to talk about not stock-specific, but the medium and near-term market case. And the reason why I ask you this is, in August, while earnings season, etc., was on, we did see a minor dip in the market. Everybody was calling a correction at that point. It was a very feeble correction, if one might point out, because we went, 100, 200 points down, and the recovery's been quite dramatic, 500-600 points on the upside. What does that tell you about how resistant this market is?
Indeed, it is, because as we discussed earlier, there's a confluence of 3 factors, so it's got great support. I think the moment will end when nobody tells you a correction is coming. So it's a bit heuristic in that sense. We do a lot of charts which plot sentiment. They still suggest some upside in the near term. We do near term stuff. I don't toss coins all the time. but it'll come. The moment will come when the market will look overdone, when it will look like the Panwala is telling us to buy stocks, and then a nice correction will come.
Okay. Anuj?
Indeed, Menika. In fact, my question was on the same lines. Hi, Ridham. Anuj from Delhi. Just wanted your opinion on what, or at what stage of a bull market we are. Because we had this 2003 to 2008 bull market, in which I can remember there were at least 10 instances of market correcting at least 10%, and in certain cases correcting 20 to 30% and giving great buying opportunity to investors. So far, we haven't had any. Do you think at some point there would be a 15 to 20% correction, which would be a great buying opportunity? Do you sense something like that coming anytime soon?
So, in 2003-04, we started at 2800 index. The date was 25th April 2003. That was the bottom of the index. By January 2004, which is 8 months, we had more than doubled. We had gone past 6,000. So if September was the mark this time, we were at 5,300.
300.
So
Another 10,000
if you apply
before.
the same logic, then but then
10,000 before a correction.
but then after that the market fell 30%. Okay, because we had a big emerging market correction. The Fed raised rates. And we had an election result which the market got disappointed by. You'll remember all that, right?
Right.
And in the subsequent 7-8 months, the market actually went down more than 30%, and everybody, of course, gave up on the market, saying, it's done, we're finished, this whole market is over. And then from there, that was the real deal, actually. From that level of 43, 44, which we hit in August, September of 2004, from there we climbed up, and that was a big run. So even if you miss the first leg, you get a sharp correction, you come back, I think you still make a lot of money. So we are in a nascent stage, these are early days actually. Okay. But the multiple comparison is very different, because in 04, even though we had gone up, we had doubled, the market's multiple was about the same as it was before this rally started. So the multiple this time around is a lot higher in that sense. In fact, I would say that the profits were as depressed as they were then. So the story was all about profits coming back, which is what I think.
Which is the case here as well,
which is what I think can happen right now. But the multiple comfort is not the same as it was in 2003.
Okay. Before we end, because we've got very little time left, and I want to put a couple of quick rapid questions to you, which is again near term. We are expecting a lot of government paper to come to the market. What will that mean in terms of absorbing some of the liquidity that's sloshing around? And really, will we see that depress some FII appetite for otherwise secondary market stocks? So that's one quick question. And secondly, besides equities, given your bullish view on the economy, are there any other asset classes that you'd be investing in?
Yeah, so on the first question, I think that will create some impediment and headwind. And supply tends to get bunched up, and also expect the private sector to raise money. We're getting past that threshold on valuations where it becomes attractive for companies to sell their own stock, and therefore there will be supply, and that may become the point where the market corrects. And it may coincide with the view change on the Fed, so it may come together. So a bit of supply builds up, and the Fed changes view, and we get a sharp correction.
That's a triple whammy.
Yeah, it comes as a triple whammy. It usually does. So you get a sharp correction. So that will happen. I would not rule out supply being quite large in the next 12 months, in excess of $20-25 billion. You can do the math. In my view, retail investors will pump maybe around $20 billion in the next 18 months. So they're going to be big buyers of equities.
On what basis are you saying this?
If you plot the share of equity savings in GDP, or the share of equity savings to gold savings versus trading returns and versus real rates, the chart's already telling me that there's going to be a big bump up in equity savings.
Okay.
Yeah. So financial savings are coming back, which is why you want to be actually first in financial services stocks. The starting point, last year financial savings were less than 7.5% of GDP, which is close to a 22-year low. It is very close to the number we had hit during our BOP crisis in 91.
Okay.
And this number was at 12.5% 5 years ago. 5% of GDP, Menika, is $100 billion.
Yeah.
Okay, it's a lot of money. Okay.
Let's hope it works out that way. Numbers are lovely to plot.
Yeah, no, I think I think that shift is already happening, and we will see a shift. So the policy of the last 3 or 4 years was to basically promote negative real rates and therefore discourage financial savings, which is why we ran a current account deficit. So that is now, I think, already changing, which is why I said that it's important that the RBI sustains its framework.
Asset classes besides equity?
I think long bonds. They look very attractive.
Okay.
The yield is at about 8.5 change. Yeah, I think it's very attractive. Should do quite well in the next 2 years.
I think we deserve full marks, Ridham. You, of course, deserve our thanks for being here. But we deserve full marks for being able to gauge what Ridham's ideal portfolio would be like, right? Full marks to us. Thank you so much for joining us here on Closing Bell. Really, honestly, thank you so much for your time.
Pleasure. Thank you.